sometimes it can be a little intimidating to start to think about buying that first home, but it's really not as complicated as people think. What is important is to have people help you, guide you through the process so that you can learn about the process and have a good understanding about what steps it takes to buy a home. Knowing that you have a really good lender or loan officer, as well as having a really good real estate agent like Manny to be able to assist is very helpful, because there's a lot to navigate through the process. One of the ways that I've heard the process described, and this was actually by a real estate agent, but it applies on both the real estate side as well as on the mortgage side. But it's almost a process where you're trying to get from point A to point B, and there are obstacles in between those 2 points. And a good lender and a good realtor can kind of guide you through that process, so you can go over, under, or around those obstacles to get to that final destination, which is where you're sitting at the closing table and signing a bunch of papers and then getting the keys to your new home. So that's what we'll talk about a little bit tonight is how do you get from point A to point B. So I'm going to go ahead and share my screen now, and I'll go ahead and run through some things with you so you have a pretty good understanding of that process. And if you're not able to, Manny, if you could let me know whether you can see the screen or not, that'll give us a good indication.
Okay. So you're sharing?
I am in the process of sharing it now. So let's see, give me just a minute here and I'll try to get that set up.
Yes, I can see, and I hope everyone can see.
Perfect. Well,
can you guys see anyone? Just say yes or show me any reaction. Perfect.
Okay, wonderful. Well, sounds good. So what I would like to do this evening is just run through some of the basics of the mortgage process, talk a little bit about some of the different loan options that are available, and kind of talk about what steps you go through to prepare yourself for the home purchase. I'll also have an opportunity to touch on credit a little bit as well, because that's always something that people are interested in, and it's pretty helpful to have a pretty good understanding of that as you're starting to proceed through the home buying process. So when it comes to mortgages, there are really two main mortgage products that most first-time home buyers typically will choose. One option is what's called conventional loans. So a conventional loan is a loan product where the minimum down payment is 3%. So if a purchase price is, say, $400,000, let's say for a townhome, 3% of that would be $12,000. And then there are some other products and options that are available that allow you to reduce the amount of cash for down payment. And I'll get into that in just a little bit. The other main, I'd say most popular program would be FHA. So with an FHA loan, the down payment is 3.5%. And we'll talk a little bit more about those two different options as we get further into it. Another option is if an individual is a military veteran, there's a product called VA, and that offers veterans of the military 100% financing, and there's no down payment with that. There's another 100% financing option, which is called USDA or Rural Development, which is another option that's available to people. The downside to that is you need to be in more of a rural area. So that would not be available in Fairfax County or Loudoun County or Prince William for the most part. It would be available further out. So if someone was purchasing in, let's say, the Winchester area or maybe Warrenton, a little ways out from Northern Virginia, that's where that option may be available as well. So, and if anyone has questions along the way, just let me know and I'd be more than happy to answer questions. I will open it up at the end as well for questions, and we can run through and answer any specific questions that you may have. When it comes to interest rate options, there are two options available. One is a fixed rate mortgage. And with a fixed rate mortgage, the interest rate stays the same, never changes throughout the entire term of the mortgage. So most mortgage products in the US are 30-year term. You do have the option generally to go with either a 30-year mortgage or a 15-year mortgage. Most first-time home buyers typically opt for a 30-year mortgage because the payments are quite a bit lower with a 30-year mortgage. So with a fixed rate, the interest rate and what's called the principal and interest payment remains the exact same throughout the term of the mortgage. With an adjustable rate mortgage, the interest rate stays the same for a certain period of time, and then the interest rate typically will adjust on an annual basis. So each year the interest rate would change. So and one option available for an adjustable rate mortgage might be what's called a 7-1 ARM. What that means is the interest rate is fixed for 7 years, and then it would adjust every year. Now, the reason someone may choose to go with that type of mortgage is if you can get a lower interest rate for an adjustable rate mortgage, and they're only planning on being in the home for a shorter period of time, like let's say 5 years, an adjustable rate mortgage like a 7-year 7-1 that I mentioned might be a good option. With the way interest rates are today, and they have been the last several years, in most cases, a fixed rate is going to be the best and most common option. Right now, I would say about 98% of new mortgages are fixed rate mortgages. And that's for two reasons. One, an adjustable rate, it can be risky if you're still in the mortgage when the interest rate goes up. It could increase that interest rate and mortgage payment to a point that could be unaffordable. Also, the interest rates on adjustable rate mortgages are really not too favorable these days. So most people end up going with that fixed rate option. Another mortgage product that's available would be a jumbo mortgage, which would be for individuals purchasing homes and having mortgages over $1 million. So those for first-time home buyers are not too common. If you're in that fortunate position to be able to take out a jumbo mortgage, that would be an option for you. One concept that's pretty important to understand is what's meant by a pre-qualification or a pre-approval. And generally the way it works when you're submitting an offer on a property is you're going to submit, your real estate agent would submit two different documents. One would be the offer, and the offer is basically just a real estate contract based on the terms that the buyer wants to offer. So let's say they're putting an offer in for $400,000 and they're looking to put 3% down and they want to close 30 days later. So the terms of that offer would be included in that offer, and then also the seller and listing agent excuse me, are going to be interested in seeing a pre-approval or pre-qualification letter. What that shows is that a loan officer has reviewed the qualifications and they provide a statement of those qualifications in letter form. A pre-qualification letter is a little bit more of a generic kind of general letter. An example of a pre-qualification letter might be, let's say you're at your bank, you're making a deposit with a teller, and you mention to the teller that you're interested in purchasing a home. So that teller may refer you to a loan officer who's in the branch at that time. If you sit down with that loan officer in the branch and they ask you some questions about your income and about your debts, they might come up with an approximate range of the amount that you might qualify for. So that's what's referred to as a pre-qualification. A pre-approval is a little bit more formal, and that involves completing a loan application. The lender would be pulling a credit report, and they would also be reviewing your income and asset documentation. Now, what that refers to would be W-2s and pay stubs, If it's an individual who owns their own business, it would mean the last 2 years of tax returns. And then also the lender would be reviewing the last 2 months of assets. So assets would include bank statements or investment accounts or retirement accounts, all three of those. And when they're reviewing that, they would also be reviewing the credit report, and they would put the loan through what's called automated underwriting. And what automated underwriting is, it's a mortgage, it's a program that includes both the credit report as well as the application. And the loan officer would put in a purchase price and loan amount and submit the loan through that program. And hopefully the result would be that it gets automated underwriting approval. If it doesn't, then what the loan officer's next step would be to make some adjustments, maybe reduce the purchase price slightly or maybe increase the down payment to get to that point where they do get that approval. So those are the two most common forms or letters that are provided to a seller or listing agent to show that the lender has done their review. There's a third version that our company actually does specialize in, which is where the underwriter, who's the decision maker on the loan, actually reviews all of that documentation, the income documentation, the asset documentation, the credit report, the application, and they actually approve the loan before you go out and purchase a home. So you may ask, why would someone choose that option? And one reason that's a great way to go is because when you're submitting an offer on a property along with that letter, you want to make sure that you're providing as strong an offer as possible. So the seller is going to be looking at it from the perspective of, if you put yourself kind of in a seller's shoes, or think of yourselves 5 years after you purchase this first home and you're looking to sell that home and purchase another home, and someone puts an offer in to purchase your home, you're going to want to make sure two things. Number one, you're going to hope that that amount is going to be as high a purchase price as possible, because you're going to want to purchase a new home and take the proceeds of that sale and use that money as a down payment on your next home. So you're going to be interested in that price. And then secondly, you're going to be very interested to make sure that that buyer is very well qualified. So if you think about those three options, a pre-qualification, a pre-approval, or an underwritten approval, that third option, an underwritten approval, is going to give you great peace of mind, because you'll know that not only did the loan officer review that loan, but the underwriter, who's the decision maker, did as well. So as a seller, you'd be very, very confident in that offer. So that's something to keep in mind when you're kind of thinking about starting that mortgage process. It's very helpful if that lender can provide that approval before you start that home buying process and before you start putting offers in on properties. So hopefully that's helpful information. One of the things that a lender is going to look very closely at is what's referred to as the debt ratio. So the debt ratio, there are actually two different debt ratios a lender would look at. And what they are is they actually take your mortgage payment and divide that into your monthly income. So a mortgage payment needs to be below a certain percentage of your monthly income. So with an FHA loan, for instance, the mortgage payment needs to be less than 47% of your gross income. The other debt ratio that a lender looks at is what's called the back end ratio, and that includes not only the mortgage payment, but your other debts. So that would include let's say you have a car payment and a Visa payment. The lender would add those two payments to your mortgage payment and divide it into your income. And that ratio would need to be less than 57% of your income. So depending on the mortgage product you choose, those debt ratios will vary just a little bit. So with a conventional loan, they really look at just one debt ratio, and that's your mortgage payment plus your other payments like your car loan payment or student loan payment, credit card payments. And that is what would help determine what price range you qualify for. Now, during the loan process, there are different individuals that will handle or manage your loan. Initially, you would be working with a loan officer. And in most cases, like in my case, for instance, I would be working with you throughout the whole loan process. So initially, the first step is to complete a loan application. So a loan application can be completed a couple of different ways. Probably the most common way to complete a loan application these days is to complete it online. But if you're more comfortable sitting down and meeting with a loan officer, that can definitely be done in person, or it can be done over the phone. And what's included on a loan application is pretty basic information, but it's information that the lender needs to review to determine how much you qualify for and to get you approved. So some of the information that would be on that application would be your name, your social security number, your birth date, your addresses, your home addresses for the last 2 years, and the dates that you lived at those addresses, as well as your rent payments. Also, your employment information for the last 2 years, along with your asset information. So that would be bank accounts and approximate balances, investment accounts and retirement accounts, and the approximate balances for those as well. And so that's pretty much would cover a loan application. There's a little bit more information involved, but that's kind of the bulk of what's included in that loan application. So the other information that a lender would need in order to determine how much you qualify for and to put together some different financing options would be your income and asset documentation, as I mentioned. So the income documentation would be last 30 days of pay stubs, last 2 years of W-2s. If you're an employee, a W-2 employee. If you're self-employed, they'd also want to see the last 2 years of tax returns. In addition to that, the lender will be reviewing your credit report. And with all that information, they can determine what price range you would qualify for, as well as some different financing options that might be available to you. At that point, once that review is completed, what I do as a loan officer is I generally will provide a couple of different, maybe 2 or 3 different financing options based on your qualifications in your situation, and then email those to you and review those with you over the phone. And actually generally I would meet in person. But if someone wants to review that over the phone, that's always an option as well. So once that meeting has happened and any questions that the borrower has are answered, they're at that point to start working very closely with a real estate agent to determine what properties they might be interested in. So the real estate agent at that point typically, so Manny would reach out and provide a list of properties or would provide a search based on the criteria that you're looking for. So let's say that you're interested in buying anywhere in Fairfax County, you're interested in a townhome, you qualify up to say $450,000. So there would be a search put together for townhomes in Fairfax County up to $450,000. So you would review those. You might receive those every day or maybe once every several days. And when you see properties that you're interested in, you would coordinate with Manny to go out and start looking at those properties that are of interest to you. And then once you find one that you're interested in and you want to make an offer on, you'd reach out to the loan officer. And, if I were your loan officer, I would put together a pre-approval letter based on the terms of your offer. So let's say you're putting an offer in at, say, $435,000 with 3% down payment. I'd review the numbers, make sure you qualify based on those numbers for that particular property. And then I would provide 2 items. I would provide a pre-approval letter as well as what's called a transaction analysis, which breaks down the estimated payments, the estimated closing costs, and the estimated cash to close. And with that information, you would review it. You may want to review it with me as well, and ask any questions that you might have. And then once you're comfortable with that, you want to make the offer, then the offer would be placed. And typically there's a negotiation back and forth for maybe 2 or 3 days. And then hopefully both you as a buyer as well as the seller come to an agreement, and become to an agreement on the terms, and there's a ratified contract. So if that does happen, then the loan process would kind of formally begin. And then at that point, the loan would be processed. The processor would kind of manage the file at that point along with the loan officer. And any additional documentation that might be needed for underwriting would be requested at that point. Also, the appraisal would be ordered as well as the title work. And the appraisal is a document that is generated by an appraiser. And what is included in that document is they will compare the property that you are purchasing with 3 homes that have already sold that are similar to your property. So let's say you're buying a townhouse for $450. It's in Chantilly. The appraiser would find 3 properties, preferably in Chantilly, hopefully close to your property, and would compare those properties to yours to come up with a value, an appraised value for your property. So that the appraised value in most cases is going to be equal to or greater than the purchase price. So if $450 was what you purchased the townhome for, in most cases, the appraisal is going to come back at that amount or over. In some cases, it might come back a little lower. If that does happen, let's say that the appraisal comes back at $440,000. At that point, the loan is going to be based on the lower of the purchase price or the appraised value. So let's say the loan was for 97% of the purchase price when the contract was written, and the appraisal comes in $10,000 lower at $440. So the loan amount would then drop to 97% of the lower of those 2 numbers. So the loan amount would be 97% of $440, and the difference in the loan amount and the purchase price is the down payment. That's the cash out of pocket for the down payment that you're paying. So in that situation where the appraisal comes in lower, there's typically a negotiation between the buyer and the seller. The buyer obviously is going to want to keep that sales price or drop that sales price to the appraised value, so their down payment stays basically the same. The seller may want to keep the sales price at the original sales price. And in most cases, there's a negotiation between both buyer and seller, and they come to an agreement either somewhere in between at the appraised value or at the purchase price. If there is no agreement between the buyer and the seller, then the seller and buyer go their separate ways, and the buyer may look for another property at that point. But as I mentioned, in most cases, the appraisal is not going to come in lower than the purchase price. And when they do, typically the buyer and seller do come to an agreement. So the loan processor at that point has ordered the appraisal, has ordered the title work, and once those items are in, they'll typically be submitting the loan to underwriting. The underwriter does a full review of the loan and generally will provide what's called a conditional loan approval. So that conditional loan approval will basically state, congratulations, your loan is approved based on the following conditions. And the underwriter may have 3 or 4 conditions that are needed in order to get what's called final loan approval, which kind of gives the green light for your loan to close. So those items may be an additional W-2 that may have been missing, maybe one more pay stub, might be an explanation on a large deposit that was made. So once those items are in, the loan goes back into underwriting. The underwriting writer does that review. If everything is acceptable, then final loan approval is granted. And then the loan can proceed to closing, which is where you sign your closing papers and get the keys to your home. So this is some information that is needed in order for the lender to have a loan application. So in the United States, back in around 2007, there was what's called the housing crisis. And if you were here at that time, you were probably familiar with it. If you arrived here later, you may have heard of that. But as a result of that housing crisis, there were certain changes that took place within the mortgage industry. And one of those changes was they wanted to make sure that, especially first-time homebuyers, but really any home buyer, they wanted to make sure that the lender disclosed the approximate costs and the approximate cash to close and approximate payments to a home buyer as early in the process as possible. So the new guideline that came about as a result of those changes was that they require require lenders now to provide a disclosure which shows those
you muted yourself, Mr. Kevin.
Okay, can everyone hear me now?
Yes.
Okay, great. Sorry about that. So, you know, at this point in the process, they wanted to make sure once there's a ratified contract, they felt it was very, very important that all home buyers to have a pretty good understanding of their approximate numbers. So about how much their mortgage payment would be, about how much their cash to close would be, and about how much their closing costs would be. So within 3 days of application, the lender provides what's called a loan estimate. And that loan estimate includes the costs of obtaining a mortgage, which are referred to as closing costs, and also contains the estimated payment and the estimated cash to close. One of the changes that took place at that time as well is they wanted to make sure prior to closing that there was an updated estimate that was provided to the buyer at least 3 business days before closing, which provided kind of an updated estimate of those numbers so the buyer knows what to expect in terms of closing costs, in terms of cash to close, and in terms of payment. So those were very positive changes, and you'll find that you're very well informed throughout the process as a result of those changes. So a couple of other things to understand is typically in the beginning of the process, so before you even have a contract on a home and you're working with a loan officer, the loan officer will provide estimates for you so you can get an idea of how much what those numbers will look like for certain price points. So let's say you're purchasing a $400,000 townhome. You know, they may provide, loan officer may provide an estimate with, let's say, a 3% down payment, a 5% down payment, and a 10% down payment. And as you review those, let's say that you look at the 3% down payment option and you look at the cash to close and you look at the payments and you talk with your loan officer, hopefully that is someone like myself, and they let you know that you have a concern over the payment. You want to try to get that payment down a little bit. So one way you can get that payment down is by paying what's referred to as points. So the option that, let's say, I've provided you is, let's say, 6.75% and 0 points. What 0 points refers to is that means that you're not paying any additional money to get that particular interest rate of 6.75%. If you want to try to get your interest rate down and try to reduce your payment, you can pay some additional money, which is referred to as points, to what's called buy down that interest rate. So what that might look like is at 6.5%, if you pay 1% of the loan amount, that may give you that opportunity to get an interest rate that's lower of, let's say, 6.5%. So your interest rate is lower, your mortgage payment is lower, but you're paying an additional 1% of the loan amount, so about $4,000 to get that lower payment. So you've got the opportunity to try to get that payment down, and to do that, you're paying a little bit more money. Now, let's say that you've reviewed those numbers and you're perfectly fine with the payments, but you'd really like to get that cash to close figure down as much as possible. So you can move in the other direction. So instead of 6 3/4 and 0 points, you could go with an option of, let's say, 7% and a 1% lender credit. So that works in the opposite direction. So with that option at 7%, we would be providing you a credit towards your closing costs of 1%, which is about $4,000. And in exchange for that, so you'd have a lower cash to close, but you'd also have a higher mortgage payment because the interest rate is at 7%. So that'll give you an idea. So, as a lender, I'll have a whole bunch of different options. And one of those options is buying down the interest rate by reducing your interest rate with a little bit more cash out of pocket, or increasing that interest rate and reducing the cash out of pocket. So there are some different options that are available to you as a buyer. And when you do lock in an interest rate, initially when an estimate is put together, let's say that you're pre-approved for $450,000 and you're looking at a couple of different options. Those options that are provided to you are going to be generally estimated based on what the interest rates are for that particular day. Once you have a contract, you have a ratified contract that you and the seller have agreed to, at that point, you're able to what's called lock in the interest rate. And that guarantees the interest rate for a certain period of time. So let's say that you get a ratified contract on June 1st, and you're looking to close on that loan on June 30th. So there are 29 days until you go to closing. So in that circumstance, the lender will probably lock the interest rate for 30 days. So that means the interest rate that the lender has quoted you is guaranteed for that 30-day period. So as long as you close within 30 days, no matter what happens to interest rates, they could go from 6 3/4% to 12%. Your interest rate is guaranteed during that time period. Now, the mortgage payment is made up of generally 5 different components. 4 of them are listed on this page, on this screen. The first, and I'll explain the 5th as well. So the principal and interest part of the payment is calculated based on the loan amount, let's say $400,000 loan amount, the interest rate, let's say 6.75%, and the term. In this situation, a 30-year term. So there's a calculation that is done based on that, where the principal and interest payment will be what's called an amortized payment. So let's say that principal and interest payment is $2,300, just using kind of an estimated number. The interest would make up a portion of that $2,300, and the principal would make up the other portion. So the interest is calculated based on the interest rate that you're paying for the money you're borrowing. So if you're borrowing $400,000 at 6.75%, if you multiply 0.0675, which is the percentage, times 400,000, that will give you the annual interest on that mortgage. If you divide that by 12, that will give you the interest for your monthly payment. So out of that, say $2,300, if $2,100 is interest, $200 would be principal. That principal portion, or $200, would be the amount by which your payment is being reduced each month. So each month, as you pay down your mortgage, a little bit more money is going to go towards the principal, and a little bit less is going to go towards interest. So if we think about that calculation that I just went through for the interest portion of the payment, and we project out, let's say, quite a few years, let's say 12 years down the road or 15 years down the road, and your balance is $200,000. If you multiply $200,000 by 0.0675, that interest amount is much, much lower. So at that point, your interest part of your payment might be maybe $1,200 and your principal portion would be $1,100. So as your balance goes down, you're paying a lot more towards principal, which means your balance is dropping at a much more rapid rate. Now, the other components to your mortgage payment are real estate taxes and insurance, and then I'll talk about the fifth component in just a minute. So the real estate taxes, you'll have an annual real estate tax amount that you're paying for that particular property. So let's say that that amount is $4,000. The monthly portion of that, you would divide that $4,000 by 12, and that monthly portion would be part of your mortgage payment. And then for your insurance, it would work the same way. Let's say that the insurance was, say, $1,200 a year. You divide that by 12, that's $100 of your mortgage payment that goes towards your interest. So what's interesting about a mortgage is you never actually pay your insurance company for your insurance each month. It comes out of your mortgage payment. So you're paying a portion of your insurance payment and a portion of your tax payment each month in your mortgage payment. And then when those bills become due, the mortgage company pays them from what's called your escrow account. And the escrow account is it's almost like a little bank account that money goes into each month. And then when the bills come due for taxes and for insurance, the mortgage company pays those. Now, the fifth component that I referred to is what's called mortgage insurance. And for most first-time home buyers, mortgage insurance is part of the mortgage payment. So years ago in the United States, the way it worked when you took out a mortgage is you had to come up with a 20% down payment, and then the mortgage company would finance the other 80%. And the reason for that was in the event that there is a foreclosure. So foreclosure happens if someone's not able to pay their mortgage. Let's say someone loses their job and is unable to pay their mortgage for 6 months or 8 months. There's going to be a certain point where the lender goes through what's called the foreclosure process. And they basically take that property back since the borrower was unable to pay the mortgage, and then they'll resell that property to a new home buyer. Now, when that happens, the lender typically can only recover about 80% of the value of the home. So, and that's because the property may not be in great condition at that point, and it's going to take them quite a bit of time to be able to sell that property in most cases. Also, the borrower may not have made mortgage payments for the last maybe 6 to 8 months. So with that being the case, they can only recover about 80% of the value. So because of that, they required that borrowers put down a 20% down payment. Now, fortunately, times have changed, and the reason that down payments are much lower now is because of the concept of mortgage insurance. So with mortgage insurance, the mortgage insurance is typically part of the mortgage payment, and that mortgage insurance is basically an insurance policy that protects the lender in the event that there is a foreclosure. So if there is a foreclosure, to keep numbers simple, let's say that someone buys a property for $100,000, it's valued at $100,000, and they put down, say, 3%. So the loan amount that the borrower is borrowing is $97,000. And unfortunately, they lose their job, and 9 months later, there's a foreclosure. So when the lender forecloses, if they'll only recover about $80,000, they're gonna really kind of be in a tough spot. So the mortgage insurance will protect them and basically reimburse them for that $17,000 they would have lost. So mortgage insurance is a concept that came about to help people put down less money and be able to buy a home much earlier than they were able to previously. So hopefully that's helpful. And if anyone has questions, just feel free to let me know. And we'll go ahead and jump into questions here in just a little bit. Now, there are some other programs. I mentioned that with an FHA loan, the down payment is a minimum of 3.5%. And for a conventional loan, it's a minimum of 3%. Now, when you're purchasing a home, there are two different, almost like buckets that you need to think of where there needs to be money to cover the costs of buying a home. The down payment generally is 3 to 3.5%, and the closing costs, which are the costs that are incurred in order to buy a home. So that would be things like the appraisal, the closing fee, any lender fees, title insurance, recording taxes. That's typically about, a good rule of thumb would be about 3% in Virginia, and I'd say in Maryland it's probably closer to maybe 4.5%. So to purchase a home, typically as a home buyer, you need to cover the down payment and then the closing costs. So, somewhere between about 6 and 7.5% of the purchase price. Now, fortunately, there are some creative ways to help cover some of that cost for first-time home buyers. Now, with a down payment, there are two different options in Virginia that are available, and then Maryland has some other options as well. But in Virginia, there is what's called a second mortgage option through an organization called Virginia Housing, which is a housing agency in the state of Virginia. Maryland has a similar agency. But with the Virginia Housing second mortgage, the way that works is, let's go back to that example of buying a $100,000 home, which obviously in our area is not really possible, but just to keep the numbers simple, let's say it's a $100,000 home and the mortgage is for $97,000. Through Virginia Housing, they offer an option where they'll also provide not only that $97,000 mortgage, but they'll provide a small loan for what's called a second mortgage for $3,000. And that allows home buyers to be able to finance the full purchase price of the home. So that's one option available through Virginia Housing that allows people to reduce that down payment to zero. Another option that is available is also through Virginia Housing, and that's a grant. So with this grant program, they will actually provide a grant for 2%. In that example, for a conventional loan, they'd provide a grant for 2% of the purchase price. And as a home buyer, you would cover 1% of that down payment. And with FHA, it's a similar program where they'll actually provide 2.5%, and your down payment is still just that 1%. Now, on the closing cost end of things, I mentioned it's somewhere between about 3 and 4.5% of the purchase price. That typically is covered by the buyer, but there are also some solutions to reduce that number as well. It's possible in certain circumstances, although it's pretty difficult in this area, for the seller to be able to cover some of those closing costs. So they have the ability to provide what's called a closing cost credit. So let's say your closing costs were 3% and the seller agreed to cover 1% of your closing costs. That would reduce your cash to close by 1%. And whether that is available or not is really determined by the market. So we are in an area here in Northern Virginia, DC, and Maryland where it's a pretty competitive housing market. So buying a home, oftentimes you're competing against other buyers that want to buy that same home. When that does happen, generally a seller is not going to be willing to cover closing costs or credit closing costs. But in certain situations where a house has been on the market for a little bit of time, it may not be an absolute pristine, perfect home. Maybe it needs a little bit of work. Those are situations where the seller may be in a position where they will look to help cover closing costs. Now, when they do, an example of kind of how those numbers may work, let's say it's a $400,000 townhome, and you put in an offer asking the seller to provide a closing cost credit of $4,000. In that scenario, a seller may be willing to do that, but they're looking to net $400,000 out of that transaction. So if you're offering them $400,000 and you're paying all your closing costs, they may take that offer. If you come in at that same price point at $400,000, but you're asking them to pay $4,000 in closing costs, they may come back and say, I'm not willing to do that, but if we increase the sales price to $404,000, then we'll be willing to pay $4,000 in closing costs. So when you're going through the home buying process, it's important to not only see things from your perspective as a home buyer, but it's also important to see things from a seller's perspective. And when it comes to a closing cost credit, that's how a seller is going to look at it. So as far as some other options available to you, and actually, let me do this. I'm going to go ahead and just kind of touch on credit just a little bit here so you have a pretty good understanding of that. So when it comes to credit reports, there are several different sections that are part of that credit report. So it's really important as a home buyer to have a pretty good understanding of your credit. There are some online sites where you can actually pull your own credit reports to see what's showing in your credit report. So it's good to know what's in your credit report and also to know whether all of the information is accurate or not. So if there is some information that is not accurate, it's possible to dispute items that are not accurate. And the way that process works is the credit bureau. So let's say you're disputing your car loan with Equifax. You place that dispute with Equifax. Equifax will forward that information to your car financing company, and then they will review to determine whether that information is accurate. So if you see your credit report that there's inaccurate information, it's important to consider disputing that information. Now, if you're in the middle of the home buying process and you're getting ready to talk to a lender and getting ready to look into purchasing a home, before you dispute an account or start disputing multiple accounts, you want to reach out to a lender to talk with them about that first, because it actually can complicate things slightly if you're in the middle of that home buying process. And I can talk individually with any of you regarding that as well. The other thing to keep an eye out for in terms of credit is if you have a freeze on your credit reports. Let's say there was maybe an identity theft issue and you've placed a freeze on your Equifax report or your Experian or TransUnion or all three. That's something you're probably going to want to remove if you're going to be working with a lender to have them pull your credit and determine what you qualify for. So just some things to keep in mind. Now, what's on a credit report would be current and past credit accounts. So not only are the accounts that you're currently paying on going to be on your credit report, but any other accounts that you've paid off within the last 7 years. So if you had a car loan that was paid off 2 years ago, that's still going to be on your credit report. As time goes on, those older accounts are going to have less and less impact on your credit score, but they are going to be part of your credit report. Now, a credit report's also going to show for each of the trade lines or accounts that you have, it's going to show your name, the account number, or actually a portion of the account number to protect your identity. If it's owned by you or if it's a joint account, maybe with you and your spouse, it will also show the date opened, whether the account is current or not current, and it'll also show the credit limit as well as the payment amount. Now, for an account to show as delinquent, it will not show as delinquent until it's at least 30 days late. So oftentimes people will think, if I've have my car loan due on the first of the month, let's say May 1st, and on May 10th, I haven't paid my car payment, most people think that's going to be a late payment on their credit report. Fortunately, credit bureaus give you 30 days before it's going to be reported as a late, and then it would show as a 30-day late. So you want to really, really focus on making sure that you're making those payments on time, and you're, and really avoiding getting close to that 30-day point. Now, also in terms of credit, people are often very interested in what is on my credit report that's going to impact my credit score. So this is a great chart that gives some really good information on not only what impacts your score, but also some helpful information on how to improve your credit score. So you'll see in this pie chart, there are two very large pieces of this pie. One is the largest piece of that pie is your payment history. So that refers to whether your payments are on time or have been late. So if someone has, let's say, some 30-day lates, or they've been 60 or 90 days late, or they have an IRS tax lien, those things are going to have a pretty significant impact on their credit score. So knowing that, you'll know what to focus on and to try to make sure that going forward, even if you've had some late payments in the past, that you stay within that 30-day period and try to avoid getting into a situation where you have delinquent accounts. Now, the second largest piece of that pie in blue is what's referred to as amounts owed, which another term for that is what's called credit utilization. So what that refers to is, let's say someone has $10,000 in credit card high credit limits. So they have $10,000 available, and their balances are $7,000. So that means their credit utilization is 70%. In other words, they're using 70% of the credit that's available to them. And in a situation where someone's utilizing that much of their credit limits, that can have a negative impact on the credit score. So in that situation, that individual would want to try to get their credit utilization rate down to about 30% or even 20%. To do that, you can do it one of two ways. The most common way would be to pay that $7,000 in balances down to $3,000. Another way that can be done is to reach out to those creditors, increase the credit limits from $10,000 to $20,000, and then that $7,000 balance would be utilizing only about 35% of those credit limits. So those are some ways to improve that. Now, the other way to improve your credit and do a really thorough credit review is some lenders do have some tools where they can actually look at a credit report. So let's say you've got every individual has an Equifax, an Experian, and a TransUnion credit report. So lenders that have this particular tool called Credit Expert have the ability to actually look at each of those three credit reports, make changes on them to kind of run almost like a what-if scenario on their credit reports to determine how they can get their credit scores up. So in that scenario, let's say that individual has $10,000 in high credit limits and $7,000 in balances. The lender could actually, on this particular program, they could change those balances down to $35,000 or $3,500 as opposed to $7,000, and see exactly how that's going to impact the Equifax, TransUnion, and Experian credit scores. They could change it to 2,000 or to 0, and it would show a projected credit score for each of those credit bureaus. So that's one tool that some lenders have available. I do have access to that and use it quite a bit. Another tool that is extremely helpful for someone in the home buying process is what's called a credit rescore. So let's say that you have $7,000 in balances. You're really interested in buying a home within the next 30 days, and you want to be able to update your credit reports very quickly. So in that scenario, a lender such as myself could review your credit to determine what those projected credit scores will be, let you know what you need to pay down. You reach out to those three credit companies, pay the amounts that are needed to be paid, get a letter from each of those companies and provide those to the lender, someone such as myself. And then what I would be able to do is forward those letters to my credit company, and they would work directly with Equifax, Experian, and TransUnion to get your credit updated and get those credit scores increased. Now, normally, if you pay those credit accounts down and you let the credit bureaus update, it will take about 30 to 60 days for your credit scores to show those new balances. By doing that credit score or credit rescore, which I just mentioned, you can actually get your credit updated within 3 to 5 business days. So if you meet with a loan officer and they pull your credit and get that application and work through that pre-approval process, and you need to get those credit scores up, within a week, they could have an updated credit report, so you could be pre-approved and put an offer in on a home. So that's a pretty helpful tool to have.
Wow, that's great information. If you can conclude, we can give like a question and answer session. I know people have a lot of questions.
Yes, that is absolutely perfect, because that was pretty much my conclusion right there. So, I just wanted to provide some hopefully helpful information to kind of give you guys an idea of what the loan process looks like, and and try to help you through that as much as possible. So I'll go ahead now and open things up for questions, and love to help you out in any way that I can.
Thank you so much. I really appreciate Mr. Kevin. Now the floor is for you guys. You can just raise your hand. I can see here, or you can chat your questions here in English or in Amharic, in any form. Please, go ahead.
And any questions in Amharic, I'm going to defer to Manny for those answers.
I know.
English I can do just fine.
I know. Any question? Who want to volunteer? Rahima, go ahead.
Yeah, hi. Thank you so much for explanation. My question is like, is it? I live in not in DC, outside of DC. Mm-hmm. So is it going to be the same? Like if I found like a house to buy in Washington DC or Maryland or Virginia, do you think it's the same thing for me? Like I get a loan or anything?
Yes, it's going to be very similar in whether it's Virginia, DC, or Maryland. Each jurisdiction has a slightly different program as far as the first-time homebuyer options that are available, but it's very similar. Now, with our company, I can tell you we have a grant program that's available as well, which I think in a lot of times, in a lot of situations, it actually works out a little bit better. But each jurisdiction does have a grant program or, a second mortgage program kind of similar to what I mentioned. The program that we have that's a grant program that's geared towards first-time home buyers is what's called a Wider Path. And this is a program that we set up about 9 months ago. And our mission with that was actually to increase home ownership for first-time home buyers, and in particular African-American home buyers, but really anybody who is looking to purchase their first home. And what we did is we set up a nonprofit where we raise money, and then we use that money to contribute a grant towards for first-time home buyers. So, our program is set up in a similar way to the Virginia housing program I mentioned, where we will provide a grant of either 2% of the purchase price or 2.5% of the purchase price, up to $10,000 to provide funds towards that down payment. But yes, each jurisdiction will have a slightly different program. So I do have, some individuals who are not, 100% set on, I'm going to buy absolutely in Virginia or absolutely in Maryland or in DC. Maybe they work in DC and they're considering buying in DC, Virginia, or Maryland. So, that's perfectly fine. And it's possible to get some options together for each area to kind of compare from a mortgage standpoint, the pros and cons of each of those areas. Does that answer your question?
Yes, thank you so much. Because we had a bad experience, me and my husband. We came from, we just came here for a visit in Nebraska from Boston.
Oh, okay.
Then we got some properties to buy, and the bank wasn't able to give us anything, and we had hard time, and we end up borrowing from friends stuff to buy it.
Oh, I see.
That's why I'm asking you that. Thank you so much.
You're very welcome.
Okay, Muma, then Rebecca.
Hi, thank you so much for a presentation. It was really good.
You're welcome,
my
Mama.
question is a little bit different. So I just want to know the voucher or the Section 8 voucher. Are you going to count it like income? So how that work?
Generally, it can be counted as income. It does vary a little bit from one program to another, but, typically it can. So, there are different types of programs that are out there. Like there are some programs, it kind of depends on what the income level is to determine kind of what mortgage programs are available. But the voucher on most programs can be counted as income.
Okay, thank you.
You're welcome.
Rebecca, before Rebecca speaks, I have two questions in the chat. One is, do you also cover out of DMV area? So maybe the Embrace or your wider pass program covers areas outside DMV areas. And then another question is, do you expect a recession in the near future, like housing market crash or recession? That's another question. And let me give a chance to Rebecca so you can answer together. Go ahead, Rebecca.
Thank you very much, Kevin and Manny, for organizing this. My question is, how is the housing market now and the interest rate? If you can tell us a little bit about that. Thank you.
Sure. It's a pretty interesting question and a kind of an interesting time that we're in right now as well. So, as far as interest rates, I guess I'll go ahead and start with that. Interest rates do vary quite a bit from one individual to another, and it varies depending on certain factors. So if someone is a first-time home buyer, generally those interest rates are going to be a little bit lower. The higher someone's credit score is, the lower the interest rate's going to be. And also the income level has an impact as well. So if the income is below a certain level, then generally the interest rates are going to be a little bit better than if the income is above a certain level. As far as where interest rates are, I'd say it's in this between 6 and 7% for the most part. It also does vary depending on whether it's an FHA loan or a conventional loan, but it's kind of hovering in that range. I'd say mostly between 6.5 to 7%, but I may have one borrower that I do a review to determine what their interest rate would be for that particular day. It might be at 7.25%. For another individual, I may review it and it might be at 6.25%. But it's generally in that range. Now, you're all probably aware that a year ago, 2 years ago, rates were lower than they are now. So what I hear from people sometimes is, well, because of where the interest rates are, because they're higher, it's just not a good time to buy. And that's not always the case. And I think now is kind of an example of that. When interest rates drop, then the housing market tends to get really, really competitive. So a year ago, interest rates were low, which was wonderful, but it was very, very difficult to get a ratified contract. If you put an offer in on a home, there might be 10 or 20 offers on that home. So you're competing with all of these other offers. So it was really difficult. Now that rates are higher than they were a year ago, it's not quite as competitive. It's still fairly competitive because we all live in an area, at least here in the DMV area, for those of you who are in this area, where the government is a huge employer. So the housing market is always, and the economy is always pretty consistent. So, even now with rates where they are, we're definitely seeing multiple offers on certain properties and not, in others there may not be. But in my opinion, I think it's a good time to buy because if you can purchase now and lock in the price at today's price, a year from now, with what housing prices do in this area, I'm confident that housing prices are going to continue to increase. You'll hear on the news that the talk of, maybe there's a housing bubble or a recession coming. And there may be, but I think where that's going to happen is not in an area like this area. Because again, the government is such a huge employer and there's a housing shortage here. So it really comes down to the simple economics of supply and demand. If you have more buyers than you do sellers over time, then prices are going to continue to increase. So, so if someone decides, well, I'm going to wait, say 3 years to buy because I think maybe housing prices will settle down, or I think I'll be making more money at that point or have less debt at that point. One thing that they're not taking into account is housing prices will probably be quite a bit higher in the future compared to where they are currently. So if I look back to, let's say, all the buyers that I worked with 5 years ago, I would say most of those buyers 5 years ago have about $100,000 in equity from just making the decision to buy a home and then making their mortgage payments over the last 5 years and just watching the values of their homes continue to increase and just paying their balances down. So is it a good time to buy? I do think it's a good time to buy. There's never really a perfect time to buy, and there are arguments that could be made against this being a good time to buy. But in my opinion, if an individual is in a position where they can qualify and it's affordable for them to make the purchase, I think in the housing market that we're in, I think it's a great time to buy. And when you're comparing, not to give too long-winded an answer, but when you're comparing, I think it's very important to compare, does it make sense for me to continue renting, or does it make sense for me to buy? So when individuals focus too much on what's going on in the economy, where are interest rates, what are housing prices doing, all those things are things we don't really have a lot of control over. But if you look strictly at the numbers and figure, let's say you have a $2,000 a month mortgage or rental payment, $2,000 over a 5-year period equates to $120,000 in rent that a renter would pay out over 5 years. I mentioned the buyers I worked with 5 years ago. Instead of paying that money and putting that money in someone else's bank account for the last 5 years, they have actually built $100,000 or more in equity over that time. So kind of a long-winded answer, but hopefully that helps.
Thank you. Any other question?
And I know the question about my contact information, Abraham, you had mentioned, if anyone is interested in that, you can see on the chat there, my phone number along with my email address is there. And I'd welcome anyone who would like to reach out, be more than happy to have a conversation with you about your specific situation and, how home buying might be in your future as well.
I have 2 questions. One is to be qualified for any amount of loan based on the income. Some people may not have 2 years of tax return. They maybe just moved to United States recently, but they have like a solid income. but they may not have that 2 years of time, like for tax return, and how those people can qualify. That's one of the questions. Another question is about a credit report or building credit. There is I think a misunderstanding out there that like everyone tells you that build your credit. So that means like we understand, oh, let me have a credit card from each clothing stores, each grocery store, then a bank credit, then here and there we have 5, 6 credit cards, and we believe that we are building credit. That's how credit means. But what is building credit means actually? Thank you.
Well, that's a great question. And, I'll give you an example that will kind of highlight that and, kind of shed some light on that. So I was working with a couple that moved here from Hong Kong about 2 years ago, and they moved in, I think it was in 2019. So like January of 2019, they moved here. And as soon as they arrived, they got a secured credit card. So a secured credit card is one in which you go to your bank, and if you don't qualify for kind of the traditional Visa or MasterCard, you can take out a secured credit card where the bank will ask you'll have to give the bank, say, $300, and they'll give you a credit card for $300. So since there's not any credit history, the bank, kind of protects themselves that way. So that's what this couple did, is they got a secured credit card, and then they also purchased a car pretty much as soon as they arrived. About 6 months later, they reached out to me and said they wanted to buy a home. So we were able to pull a credit report and have credit scores after, I think it was about 7 months, and they closed on a home 8 months after they arrived in the country. So it's very, very possible to build credit really quickly, and you really don't need to take out a lot of credit in order to do that. Just a couple of accounts should do that. Just make sure of a couple of things. One, that you're making your payments on time, and two, that with a credit card or a department store card, you're keeping your balances really low. And by doing that, you can establish credit very quickly, and you should be able to get a pretty high credit score pretty quickly as well. It doesn't take 5 years or 7 years. You can do it very quickly. So does that help with that answer? And then also on your other question regarding being new to the country, as a lender with us or with other lenders, we do look at a 2-year history in terms of employment and residence history, but that can be outside of the country as well. So if you've relocated, say, from Ethiopia or another country within the last 2 years, as a lender, we would want to see that job history over the last 2 years, even the portion from the other country. And we want to see a consistency of work history over that 2-year period. But moving to the country recently within the last 2 years is not going to keep you from being able to qualify for a mortgage.
Perfect. Thank you.
You're very welcome.
Any other question? You guys can write here. My contact address, Mr. Kevin contact address here in the chat. You can reach out.
I think you're muted, Kevin.
Kevin, you.
Sorry about that. Hit the mute button by mistake. But yeah, as I was starting to say, love to help anyone who's on the call here out in any way I can. Even if you just have questions, feel free to reach out. My contact information is there. And, my encouragement to you would be, whether you're looking to buy in the next couple of months or even if it's a year or two out, it's always really important to plan. And, what I have found is that a lot of times when there's a really big financial decision, as buying a home is, with the other types of big financial decisions, people generally tend to plan out way in advance. It might be years or even decades. So if you think about retirement, and when people save for retirement or they save for their kids' college education, You know, a lot of times that may be 5, 10, 15, 20 years of planning that goes into it. Buying a home, a lot of
You muted again, I think.
Okay, I'm sorry. I'm having a bit of an issue with my laptop here, but yeah, I was just saying that you know, it is important to plan when it comes to buying a home, just as it is with retirement planning or planning for your kids' college education. So even if someone's looking to buy 2 years down the road, just getting an idea of what steps you might need to take, you know, can be helpful. So again, any way I can help out, I'd love to, and I really appreciate the opportunity to be able to share some of this information with you this evening, and I hope all of you have a wonderful evening.
Thank you so much. I really appreciate. Thank you.
You're
Thank you,
welcome.
everyone, for coming, for showing up.
Have a great evening. Good night.
Bye-bye. Good night.
Thank you. Bye.